of a class I took at Stern while I was working on my MBA. Camille and I were classmates at the time, so we we go way back. Uh, both IBMers and happened to be in class at Stern Business School. Um, yes, I work at the intersection of cyber, emerging tech, blockchain work, building solutions, building controls for really complex systems for federal agencies. Been doing some work as well with banks, predominantly central banks, looking to digitize their currencies and their infrastructure. So helping to think about how that path would look like if they need to, some cases, refactor their applications or re-platform the applications as they look to embrace some of the digital tokens and projects that they're looking to embrace, where they can really compete with some of the central banks and all the fintech players in the space. So I'm really excited for this conversation. Also thinking back to what Camille just mentioned around all the security and privacy considerations that central banks need to think about as they look to embark upon this space. I feel like I might be back on the stage again next week to lend some of my thoughts on that
Yes,
space.
right.
But that's me in a
Thanks.
nutshell. Excited. I'm looking forward to this conversation.
Thanks for the self-registration. I'll take it. Jay?
Hi everyone, good day to you. Hope you're having a great day wherever you are. This is James in the Red. I'm based in the UK. I work for MasterCard in the new payment platforms business, which is a part of MasterCard that focuses on everything that isn't card. And any opinions today are going to be mine and not those of my employer, because that's the social media policy that I have to abide by. But really looking forward to the discussion. I have only recently kind of gone deep into central bank digital currencies and started thinking about that, and it was prompted a month or so ago via a blog of a kind of really innovative thinker in the payment space that I love reading about. And it really provoked thoughts in me on a Sunday morning as I was waking up and scrolling through my phone, and got me interested enough that I then started writing a comment on that blog, which then turned out to be so long I had to go and write a blog about it. So that was my introduction to central bank digital currencies. I've been thinking about blockchain and digital ledger technology for a few years now. I was first thrown that question by my employer 7 years ago and got locked away in a room in Dublin with some colleagues to think about blockchain and digital ledgers and what that might mean and what we should do about it as a business. And it's been very influential for me in terms of thinking about holistically what are the challenges in payments and what we need to do to make things work better. And I always like to start from that. I like to start from what is the problem, and therefore is this a solution? And that's hopefully some of the thinking I can bring to the conversation today. Thanks very much for the opportunity, Carmel and everyone. Great to be on stage with you today, and looking forward to the discussion. Back to you.
All right. Hi, everybody. My name is Daniel Dan. I'm a solution architect with R3, but I'm actually transitioning between roles. So I've wrapped up my job at R3, and I'm about to start a new role with the Bank for International Settlements out in Hong Kong to support their operations there and to spearhead some of their CBDC work in APAC. Carmel, thanks for having me back. It's a pleasure to be with everybody again. Rockstar lineup. So I'm excited to see where the conversation goes. Of course, I guess maybe just quick intro on my work. I've been working with R3 for just over 3.5 years now, and I guess my intro into CBDC was with Project Jasper. That was back in 2017. Since then, I've been kind of doing CBDC work with various central banks around the world. Most recently and notably was probably the work with the Banque de France and the Swiss National Bank. That is an ongoing project right now. And over the years, I've done some work in retail and in wholesale CBDC across different vendors. So very, very excited for the conversation today. Carmel, I'll pass it back to you.
And Daniel, I'm so sorry I didn't see you join the room. I thought I was the
Oh,
last person on stage, so apologies.
no worries at all, James. Thank you, Inez. Oh, and I'm calling from Toronto, Canada, so I have to represent the Canadian side of the room.
Thank you. Right before you head to cool Hong Kong, huh?
Yes. I'll represent there as well. I promise.
All right, very good. Well, I'll kick it off by asking a generic question, and Daniel, I'm going to start with you just because I know R3 has done a lot of work with that. What is a wholesale CBDC, and how does that fit into the broader payment system that we know today?
Yeah, it's a great question. And I guess that's a good question to start off with because, it's kind of definitional in nature. And I guess without zeroing in on what exactly we're talking about, the conversation won't be very informative. So I guess I would say maybe I would define wholesale CBDC by what it isn't. And it isn't a generally accessible payment instrument. So I refer a lot to something called the money flower. It was a great piece of work that was actually done by the BIS, I think, in around 2017. And in that money flower, you can see the different attributes of different payment instruments. If anybody's sitting in front of a computer right now, listening to this, and you want to Google the money flower, it's a very informative diagram. But
I
what you
just
can see in that
tweeted it.
diagram,
I just tweeted it so you can see it.
oh, amazing! Thank you. Look at that multi-channel, omni-channel experience we're having here between Twitter and. So what's interesting about that, and the reason I bring it up is because when you look at that diagram, you can see that a general purpose CBDC and a wholesale CBDC, their only distinctive difference in their attributes is that one is generally available and the other one is not generally available. So wholesale CBDC is not generally available to the public, which is what makes it first and foremost kind of an interbank payment mechanism. I think what's interesting is as a consequence of that, the way the instrument is used is very, very different. If you think about a retail payment system, the trivial example is to say, how do I use this to buy a cup of coffee or, a carton of eggs at the grocery store? With wholesale CBDC, the use cases are very different. It's often, how do I use this to settle a payment for security, or how do I use this for large volumes of money over a course of time, or for cross-border payments of large value. I think one figure that I'll just put out there to contrast between general purpose kind of retail CBDC versus wholesale CBDC, or just retail payments versus wholesale payments. This is this interesting statistic that sat with me and I think will maybe help kind of anchor the conversation, is that when you think about retail payments like buying coffees and cartons of eggs and any payment that you and I make digitally or physically in cash, that's usually counts for 10% of the value of any domestic system and about 90% of the volume of transactions. Counter to that, when you think about the wholesale system counts for 90% of the value, so very, very large sums of money, but only 10% of the number of transactions. So maybe just kind of for our listeners, you can keep that in mind as we go. And I'll leave it with that. I'll pass it back to you, Carmel.
Oh, thank you. James, any thoughts from you on how do you see this space? How do you see, based on what Daniel just mentioned, what is a wholesale CBDC to you based on your research and given your relationship and your knowledge of the banking system, what are the potential impacts or drawbacks maybe that you see?
Thanks, Kamel. So yeah, and Daniel, thanks for bringing people's attention to the money flower. I've not heard it described that way, but I think it's a far nicer name than a four-way Venn diagram. But yeah, I agree. I think it's a really useful tool, and thanks, Kamel, for popping it up on Twitter because it's reminded me and have saved me going searching on the Biz website for the right paper. So what are wholesale CDBCs for me? Well, effectively for me, it's a way to increase the level of access to the payment system for non-bank entities. So the way I think about this is that the way it works, and I'll use the UK as a frame of reference because it's the one I'm perhaps most familiar with as a UK citizen, is that in order to arrange payments today, you typically need to be able to play in the wholesale space of central bank money. So we have different payment schemes in the UK which fulfill different objectives. One is a batch service, which is used a lot for bill payment. It's used a lot for salary disbursement. And we then have a separate scheme which is called faster payments, which, as the name suggests, allows you to make payments in almost real time. But both of those still require money to move between banks. So while I may be an account holder at Bank A and I want to send money to Daniel who's an account holder at Bank B, it's very rare that that money actually moves between banks in real time and is cleared and settled in central bank currency. Typically what happens is at various points throughout the day, all the banks basically tally up all the movements and then they decide that wholesale amounts of money move between them depending on all the movements that have happened between their respective account holders underneath. And they typically do that by being part of the central bank real-time gross settlement system, RTGS. And that's why the RTGS typically, as Daniel was pointing out, moves very large transactions, but in relatively small amounts of volume. And if you're a new participant in this ecosystem, if you are a fintech or a non-bank financial entity, or potentially even a new bank, you need to be able to get access to the payment systems. And it means either you have to be big enough and bold enough to get an account with the central bank to move money through RTGS, so that you can then participate fully in the payment system and your account holders can receive and send money in the same terms as other institutions. Or you need to be sponsored by a bigger bank who says, we will do that on your behalf. And in effect, the ability to use the RTGS and become part of the central banking system can be potentially a barrier to entry for new companies that want to participate. And so one of the things that I think is interesting about a wholesale CDBC is that it could create a lower barrier to entry for new companies to participate in the payment system. And so it effectively would allow more competition and more innovation to flourish. And so that for me is what's quite exciting about a wholesale central bank digital currency, is that it could create a totally new pool of liquidity that allows people to participate, allows people to organize transactions without having to be a big bank with all the capital and liquidity and all the other restrictions that come with the regulation of becoming a clearing and settlement bank in real-time gross settlement in central bank money. So that's what I think is about interesting at the kind of the top level. And there's probably a whole host of challenges and problems within the system that also a wholesale central bank digital currency could solve for. But that's the first one that I go to when I think about this problem. This is James the Red. I'm finished speaking.
All right. So you said the L word, which I'll come back to. Wale, any thoughts on that at a high level for the wholesale CBDC? What you're seeing here, given your work with the banks too, what's happening? Because the wholesale CBDC, and there's a component of a stable coin as well that we'll talk a little bit more on that. But what are you seeing from a wholesale CBDC?
Yeah, so the perspective that I have is, I think, back to the L word around liquidity and how that comes into the
Yeah.
ecosystem. I think generally banks in general, traditional regulated ecosystems, there's the reality that they're all encumbered by their ability to engage and participate in the entire crypto space. And often, I think, when you think about it, it's the lack of clarity from a regulation standpoint, and thinking about all the enterprise grade, like the governance, the risk frameworks, and all the traditional handholding that we have to do to afford them the ability to engage in the space. So to me, that's the biggest challenge from an adoption standpoint. We're given or empowering banks, central banks, with things that we've done in a traditional sense, right? Where we, do vulnerability scanning, we give them enterprise grade infrastructure where they're not necessarily messing around with MetaMask wallets and wallets that we use when you think about individual investors, but giving them this framework around governance or risk and compliance well, cleanly delineated lanes from an enterprise standpoint are some of the conversations that I'm seeing now. And ultimately, I do think, thinking about the work that you're doing, Camille, with MTech, where it's really a solid enterprise grade sandbox where banks can go in, experiment, build pilots, and start to look at this notion where currency isn't necessarily a traditional paper. How do we tokenize safely? How do we put real guardrails around our approach to start to digitize our currency and enable access and giving it different utilities where it's more fungible, where you can do payments and settlements of transactions on a near real-time basis where they're not necessarily doing all kind of technical gymnastics to make legacy systems work. So that to me is really the exciting space. And those are the kind of conversations that I'm seeing going on right now, where now we're moving away from the days where it's just not entirely clear. The intention is there when you think about the bank, think about banks that are currently looking at the tech, but giving them the guardrails where, hey, you can do this safely. They're security solutions, infrastructure solutions, where they're cloud native, gives them the ability to even run some of their workloads on-prem if they choose to, but giving them the flexibility of embracing CBDC utility is really what I'm saying, and I really think that's a really exciting space that we're going to continue to see involvement with down the line.
All right. So we've talked about a few things here. So the liquidity aspect of it is something I want to come back to. And Daniel, maybe going back to you, the concept of a central bank issuing a central bank digital currency that is only available to institutions, to banks, but on the other side, still those institutions with the concept of still using traditional SWIFT or ACH or any other corresponding banking mechanism. In my mind, there's a disconnect, of course, from a technology perspective, that if a central bank were to issue a wholesale CBDC, it would make it very difficult for a bank to continue to operate on the other side. So have one accounting system that's traditional versus on one side you have digital currency at the central bank. Are there opportunities, that we can talk about, whether it's for the banks on the, stable coin slash, I don't want to say DeFi too much, but the stable coin aspect of it that helps harmonize and tapping into that liquidity that we're talking about here? Because just for everyone's benefit, the concept of that James mentioned, today, it takes on average of 2 to 3 days generally for a transaction to go from one book to the other. Apps and service providers make it look like it's real time, but the real settlement in the back end takes days. And therefore, if you imagine, if you send money to someone, the money comes out of your account, but they have not received it. There is a middle world, and I call it the cloud, but now we can say the cloud. But the money, it disappears and doesn't exist really for use. You can't purchase anything with it because you actually sent it to someone else. The person did not receive it, therefore they cannot yet pay their rent with it. And the bank has a float, some people would say, and there's a lack of liquidity at that level that happens. And when you think about the opportunity of having real-time settlement, if you could provide a digital currency, a distributed ledger where the transactions are settled almost in real time, you have real visibility of your liquidity positioning, you have real visibility on your partners and what's coming in, what's coming out, your ledger is up to date. can you do more transactions in a day? Can you move more money? So there's a concept of the velocity of money as well. So Daniel, bring it back to the question is, what does that look like? If that really is an opportunity to create liquidity, in my mind, on one side you have CBDC, on the other side you have a SWIFT or a typical ACH. Are stable coins the way to go, and opportunity there on the other side, on the interbank side?
Yeah. Yeah, you touched on a lot of interesting points in that question, Carmel. I'll try to answer. I'll try to hit on as many of them as I can. And as I was listening to James and Wally talking about the what is wholesale CBDC, I realized that I didn't even answer the first question. I think I spoke more about wholesale payments in general without really talking about the CBDC. Listen, you were referencing the word stablecoin quite a bit, and I think it's interesting to kind of make sure that we speak clearly about the difference between a central bank digital currency and a stablecoin, right? A stablecoin, has its name implies that it's some type of tiered instrument where there's an asset, there's a stable asset, and then there's some type of coin that's pegged to it. So leaving that aside, I think I would think about CBDC as an instrument that bears the liability of the central bank without thinking about what the actual kind of implementation structure itself is. I wouldn't really call a stablecoin a CBDC unless it's pegged against a fiat currency and the stablecoin is issued by a central bank, in which case, it's probably more of a CBDC than a stablecoin. So let's talk about wholesale CBDCs, and let's talk about kind of the issue around liquidity. And I think it's interesting for you talking about settlement time as well in the context of liquidity, because when you think about that settlement time, which in general is usually T+2, so from the time of the transaction, 2 days until the transaction actually clears, of course, having that money kind of trapped in the system, not existing at the sender and not existing at the recipient, creates liquidity issues because the money is otherwise kind of missing. So when we think about the value proposition that wholesale CBDC can make, I think you're on point when you say you can do settlement quicker using CBDC. You could also do settlement quicker in general. Even using not necessarily central bank digital currency. You can do settlement quicker through many different optimization tricks. The issue with faster settlement is that everybody needs to do it all at the same time. So it's going to be the weakest link in the chain that is going to determine that T+2 settlement time. And even when we were working on Project Jasper, 3 years ago, we could show that we could do settlement in T+0. The issue is if you can do settlement in T+0 within Canada, if most of the trades are happening between Canada and the U.S. and the U.S. is T+2, well, the fact that you can do T+0 doesn't even help you really. So there's always that tricky issue of trying to get settlement time quicker and quicker, but at the end of the day, it's a network effect. So you really have to move the market together and incentivize everybody to settle faster and everybody to kind of upgrade their settlement tools to things that can settle faster. The interesting thing about liquidity, I mean, it's interesting because I guess the holy grail is saying, everybody wants to have liquidity. Everybody wants to have liquidity because without liquidity, you can't really do anything. You're stuck in what's called gridlock. But the interesting thing about liquidity is that liquidity, it stands at odds to some degree with real-time payments. And what I mean by that is when you think about RTGS systems, and the name is real-time gross settlement systems, most RTGS systems, they actually aren't pure RTGS systems. They aren't RTGS systems in a sense that I only send a payment as an institution that participates in an RTGS system. I don't only send payments when I have the available liquidity to execute that payment. In fact, what happens is a lot of these RTGS systems, they have liquidity provisioning mechanisms so that I can send a payment without really having the liquidity, but they give me intraday liquidity so that I can execute my payments during the day without actually taking out any loans past that intraday period. So it's interesting kind of thinking about this holy grail of saying we want to have liquidity on the one hand, and on the other hand, we also want to have real-time payments. And if you reason about those two things kind of closely, you realize that they actually kind of contradict with each other, because if you're sending real-time payments, it means you must have the liquidity to do so. because otherwise you can't send the payment. But you also want to be able to send payments, or you want to be able to take that intraday quite. You don't want to have to preserve the liquidity buffer all the time. And it's interesting, I guess, maybe to ground the conversation again in something kind of a little bit more intuitive. The average wholesale institution that has access to a central bank balance sheet usually transacts 10x their balance sheet in any given day. So, the equivalent to that is saying I walk around with $100 in my wallet, but I spend throughout the day, inbound and outbound, over $1,000 on average. And I think that emphasizes the point of liquidity is really important in the system. Because if I can only make a payment when I have enough money to make it, if my balance is only $100, but I'm sending $1,000, sending and receiving $1,000 throughout the day, I will rarely have the liquidity I need to execute real-time payments. So on the one hand, we want real-time payments with instant settlement. On the other hand, we also want liquidity. And if you think about the volumes, they kind of contradict each other. Almost by definition, they contradict each other. So I'm not sure if I'm answering the question directly, but what I would like people to maybe leave with is the tension that exists between real-time payments, especially on a wholesale level, and this notion of having liquidity or liquidity provisioning. And that's why when you look at a lot of the work that's been done in the wholesale payment space, you see this liquidity provisioning mechanism and gridlock resolution algorithms and things like that kind of pop up all the time, because that's the significance of them. Because without these things, you ultimately will have to go to deferred and netted payments all over again. And I don't know if there's any follow-ups on that from any of the speakers, but I'm happy to open it up.
Actually, before somebody tunes in, these are all great points, and I'm so sorry to interrupt. I just want to reset the room really quickly. Thank you to everybody in our audience. I also want to acknowledge that we have some past speakers in here. Nita and Paresh, they talked at our retail and financial inclusion event, so thank you for that. And then Diane Maurice was here for policy and technology. Dave, who also just joined us on stage, I recall you attending a previous room, and he had some great points on wholesale CBDC, so welcome to the stage, Dave.
And
Dave?
Daniel, great points. Honestly, I did not have the appreciation for what you just mentioned. So thank you for clarifying that, because in my mind, and maybe throughout the literature as well and the research, kind of thinking about settlement in real time, making room for liquidity. So the quicker you can get money from another bank, the quicker you can actually send money to another bank. But you're right, the trading, kind of the credit that gets issued against the reserve at the central bank, maybe this is where we'll transition and talk about, I mean, when you look at what's happening at the stable coin level and how some business models are evolving and emerging right now as far as how they create liquidity, how they earn yields on deposits. I think there's something there that's worth talking about. But Dave, do you want to jump in? Welcome back, Dave.
Absolutely. I'll just add. Dave. I'm humbled by your presence just by going
Oh,
by
knock it
Dave.
off.
I had to look and see if this was the Dave Birch.
The,
It's a pleasure to share the stage with you, my friend. I'm a huge fan. Thanks for joining.
Well, it's very kind of you to say so. Thank you. I just wanted to say two quick things. Well, I wanted to. I mean, I don't really want to do this, but I will argue with James slightly because I missed part of the conversation. But James, earlier on you said that wholesale CBDC was a way of extending access, but of course, I don't think that's true. In fact, I think the opposite is true. The point about wholesale CBDC is it's for financial institutions, and I think one of the things that's not helping the conversation, which I think confuses some of the people that are listening, is that we're calling the two things digital currency. Wholesale digital currency and retail digital currency are two completely different things. They have nothing to do with each other at all. So I think just as an experiment, I'm going to call retail central bank digital currency fish sticks from now on, so that it sticks in people's minds that it's different. So the issues that you were talking about, I send some money to my friend, and the bank sits on it for 3 days. Actually, my favorite example of that was in the US. A woman who went to visit her friend, got to her friend's house and realized she'd forgotten the nappies for her baby. So her friend, this is in the evening, her friend ordered nappies on Amazon, and 7 o'clock the next morning, the nappies were at the door. So she said to her friend, well, how much do I owe you? And it was whatever it was. I don't even know what nappies cost, $30 or something. So she logged into her online bank account and sent her friend the $30, which took 5 days to arrive. And the woman said, for that reason, well, how can Amazon get nappies anywhere in the continental United States within 12 hours, but it takes 5 days for the money to get there? Why don't we get Amazon to send the money? I mean, literally, why don't we just get Amazon to take bundles of $100 bills and pass them around? That would be quicker. So that's the problem of fish sticks. Okay, so fish sticks fix that problem, because if I send my fish sticks from my wallet to your wallet, that's the end of the story. They go from my wallet to your wallet. There are no banks or faster payment systems or intermediaries or credit accounts or liquidity or deferred net settlement or anything else. The fish sticks just go from me to you, end of story. And it's nothing whatsoever to do with wholesale central bank digital currency. That was my first point. And I did think that was confusing to some of the people listening, but I might be misinterpreting a little bit of what I heard. The second point is about, why do we want wholesale central bank digital? Why do these financial institutions want this? Well, the answer is, and actually, I think one or 10, again, I'm criticizing, and I only half heard the conversation. I think one or two people said settlement, sort of slightly. The point about wholesale bank digital currency is there is no settlement. So when the wholesale bank currency goes from, when UBS sends, the central bank digital currency dollars to Barclays, that's it. That's the end of the story. There is no T plus anything. There is no settlement. The money just goes from A to B. It's not credit. It's cash, effectively. So why do they want this? This goes back to the very early days of when people started messing around with blockchains and started to think, you know what? Shared ledgers of some kind might actually be a more efficient way of doing some kinds of financial transactions, right? Share trading and all this sort of thing. So if I'm going to put shares on the blockchain, to put it crudely, and you're going to buy my shares, it doesn't really help the overall efficiency if you can send me the shares from one Ethereum wallet or Quorum wallet to another Quorum wallet, but then we have to go and phone up the bank to get the money. That doesn't work. We need to have money on the blockchain, and because we can't put bank credit onto the blockchain, I can't put my Barclays accounts onto the blockchain. I
Well,
need some money that I can put on the blockchain.
well,
And
can can
that's where
can
wholesale
can
central
they?
bank digital currency comes into it.
Yeah. So
No,
Dave,
well,
that's a
obviously
very
that would.
interesting. That's a very interesting statement, because I mean, what about the fact that we can put our fish sticks on the blockchain and
Well, I
earn?
don't think you can put fish sticks on the blockchain either, but that's a completely separate issue. Look. So let's say we're implementing, whatever, some sort of wholesale bank digital currency, and
Yeah.
we're implementing it is in a pretty standard way. So we're implementing it as an Ethereum smart contract, and we're going to do delivery versus payment. Okay, and we have no wholesale digital currency, so I'm going to use money that's in my Barclays account to carry out this transaction. So there are a million nodes on the network, and the smart contract gets executed a million times simultaneously on all of these nodes. And there are a million requests coming from all over the blockchain to my Barclays account to transfer money from A to B. That doesn't really sound right to me. The point is, smart contracts can only move value that's on the blockchain, right? If you want to move value that's off the blockchain, and actually the Deutsche Bank the Bundesbank just published quite a good report about this. There's the Swiss one as well. But they said, look, you don't need a wholesale digital currency to do this. You can do it in another way. And actually, I worked on a system to do this in Belgium about 5 years ago. So what you can do is you can have an oracle, which is looking at the bank account balances and posting them to the blockchain. You can execute on the basis of those balances, and then you have a savant, which is monitoring the blockchain balances and then moving the real money across the RTGS. So you can do it without a wholesale digital currency. But there are some reasons for thinking a wholesale digital currency might be a better way for doing it. So my 2 points really are, one, retail digital currency and wholesale digital currency are entirely unrelated and have nothing to do with each other. And secondly, and this is where I'm curious to prod the other speakers into telling me that I'm full of it, the point about wholesale digital currency isn't anything to do with existing speeding up settlement and all this sort of thing. It's to do with this technical issue of how do you process transactions on blockchains or some other form of shared ledger when you don't have any money on that shared ledger. It's a solution to that specific problem, I think. So that was my 2 points anyway. So thank you for listening.
So Dave,
Fascinating.
your dinner sounds pretty good. You're obviously cooking while you're talking, which I appreciate.
It's not quite ready, but yes, you're absolutely correct. The most relaxing part of my day is cooking dinner and listening to whatever's on Clubhouse. Yesterday it was tips for dating wealthy men, which is very good. Today it's wholesale CBDCs, and I'm enjoying it just as much.
Solid multitasking.
I assume you're cooking fish sticks. I'm going to picture that in my head.
So first of all, Dave, I think fish sticks versus wholesale, right? Completely agree. They're two different things. We said that up front, and that's why the title runs wholesale. So yeah, they are different things. We're not talking CDBCs generally. We are specifically talking about wholesale. And to the point about liquidity and does it speed up liquidity? Yeah, I don't think it makes a blind bit of difference, if I'm honest with you, because the way I think about payment systems and how they work, that whole problem of managing liquidity, I think, has been pretty well managed. It obviously depends where you sit in the ecosystem, which country you're in, and what the challenges there are, right? But I do think that wholesale CDBCs can solve for access, in that I think it allows less mature, less robust institutions to participate in transferring CDBCs wholesale between themselves than them having to join into the full clearing and settlement regulation and being a fully regulated bank with an RTGS account at the central bank. That I think is that for me is the big difference. But it sounded like you disagreed, so I was kind of curious as to why.
Sorry, I have my microphone off again. Because the only people that will access wholesale CBDCs are financial institutions. So what the Bank of England has done, which is very good, and I think it's a template, and I think other people will do something similar. The Bank of England have created a new type of settlement account, the omnibus settlement account, which will allow institutions to hold CBDCs on behalf of customers. But the customers don't have the CBDCs. It's the financial institutions that have it. It's like they get a sort of master merchant account,
I don't dispute that. What I'm saying is it could be a different class of financial institution, right? Or it could be a non-bank financial institution. It could be a fintech. It could be a payment institution, etc. Right?
Well, the bank has already extended the settlement accounts to non-banks. I mean, TransferWise has a Bank of England settlement account.
Yeah, but you're
so what the bank said
tens, is not hundreds or thousands, right?
No, it's not that many at the moment. And the reason for that is obvious. It's because you have to pre-fund the settlement accounts. Because as you pointed out earlier on, there's no credit in the system. If you're going to trade one of these settlement accounts through the day, you have to pre-fund it. You can only trade up to the amount that you put in there because they're not going to grant you any credit. And so actually, if you're going to spend the day moving money in and out of these accounts, if you're someone like TransferWise, let's say the maximum amount negative, if you like, that you would go during the day is £100 million, then you've got to pre-fund with £100 million. I mean, they don't, because obviously companies don't want to give up their own balance sheet. So actually banks lend them the £100 million to front it up during the day. But yeah, you're right. I mean, there's no credit in it. And so it's not for everybody. That's why the banks brought in these omnibus accounts for people. But the point is that I think we're agreeing on the central point, which is the users are financial institutions. So it doesn't help me speed up transferring money from me to my friend because it has nothing to do with that application, right?
Yeah,
Yeah,
I
but one thing I'll challenge here is I do see a scenario for the liquidity aspect of it, because when you think about the access to the central bank, and maybe that differs from jurisdiction to jurisdiction, but like Daniel was saying, some banks have intraday liquidity. If you are JP Morgan, or if you are Standard Bank of South Africa, for example, you can probably command issuing credit against your reputational credit rating, right? Against your credit rating, and say, I have 50% of the volume or the transaction of the liquidity that I have that in reserve, but the other 50%, you guys are going to have to trust me that I can actually settle when there is a settlement need. And that can create, and today the way that looks is, the banks can actually create that and extending credit above their liquidity ratios. But in tomorrow's world, assuming that you had a wholesale CBDC, the same way we're saying right now in the retail space of what a stable coin can do, which is the commercial stable coins we're talking about, and a bit around, someone mentioned the smart contracts. Is there a possibility, a view here of how that can be addressed on a blockchain? Because I think that liquidity can be very powerful at the wholesale level as well. Sorry, Daniel, I think you were going to say something.
yeah, sorry, but Dave, if you want to answer Carmel's question, I can jump in right afterwards.
There we go. Oh, sorry, I keep pressing the wrong button. No, please go ahead, Daniel. People are already bored listening to me. Come on.
I think I was gonna, I was gonna talk a little bit more about the access, and I think that on the one hand, when we talk about wholesale CBDCs, to go back to the earlier part of the conversation, I referenced the money flower, and I almost said by definition, wholesale CBDCs aren't accessible to the general public. So this notion of access, I mean, listen, if a central bank
I
wanted to
apologize,
open,
Daniel. I missed that. My mistake. I apologize.
so I agree that in a sense, if we say, hey, if a central bank wants to open accounts for for every retail individual, the challenge is operational as opposed to policy and governance and so on. So even if the technology of wholesale CBDC could enable that, I think that by definition, let's talk about wholesale CBDC as something that's made for regulated financial institutions, regardless or not if we're talking about reserves or if we're talking about a distributed implementation or a CBDC-like implementation. I think the thing that I spend time thinking about and working on is when you think about how these things scale up as systems, and if you think about, like, let's think about open banking as maybe a counterforce to a CBDC that's built on top of a distributed ledger. And when you think about open banking and you think about how a system with N participants, all with API layers, integrate into each other, well, for everyone to integrate into everybody else, you need some you need some number to the N of combinatorial integrations for a group of N participants to all communicate with each other, each one with their own API spec of how you talk to my financial organization. On the other hand, if you think about a distributed system where you have bearer assets on the network, I don't need everybody to integrate into my custom bespoke API, creating this, exponential, combinatorial, chaotic framework. I can simply say, this is my representation of a liability of my liability, assuming that I'm a central bank. And now anybody that can custody this can make a claim against this instrument. And I think that when I think about technically how to integrate different components, this loose coupling that's enabled by the technology, in my mind, does lower the barrier for integration and access. And maybe to make this example come to life, when I think about dollar liquidity swap lines that the Fed is running, I would raise the question of how come the Fed doesn't run dollar liquidity swap lines for every central bank in the world? And the answer to that is because of the operational logistical nightmare that would be. And if I'm not mistaken, they used to run 9, and then after the COVID crisis, they upped that to 18 and doubled the number because this dollar liquidity was needed. So how come that 18, doesn't double again and again and again until ultimately every central bank in the world has access to dollar liquidity and they don't have to go through intermediaries? And I think, and this is an assumption that I would love to either validate or to have somebody oppose, that it is challenging giving access even when you would like to give that access using today's current systems. And my intuition over the last little while of seeing these systems up close and personal is that it does enable that type of access when it's desirable in the right kind of circumstances. So any comments on that would be valuable.
Well, I mean, you did maybe think the first part, because I mean, the banks don't have a combinatorial connection now. I mean, if I send money to James, let's say I'm with Barclays and James with NatWest, it doesn't go from Barclays to NatWest. As James said earlier on, it goes to Barclays send it to the faster payment network. From the faster payment network, send it to NatWest. Actually, they don't, because as James pointed out, it's a deferred net settlement system. But you get the general point.
And
So
what if we
the
extend
banks
that?
aren't
What if we
all
extend
connected to
that?
each other.
And what if we extend that to cross-border, banking relationships that don't share a common RTGS?
Oh well, now you're treading in some different territory there, because I'm already in trouble on FinExtra for mouthing off about Swift and
That
their
was going to be
CBC.
my next question. Where is Swift?
Tell us about the trouble.
Well, look, I stand by my point. If we're all using, forget wholesale CBDCs for a second. If we're all using retail CBDCs,
What's the point?
it's not obvious what Swift is going to do. It's not. And you can dress it up any different way. But the point is, if I'm sending money from, I mean, let's use Facebook as the example, right? So Facebook today announced that they're pulling out of Europe
Mm-hmm.
and they're launching their US dollar stablecoin with I forgot the name of the bank. But if I've got some
I think
dollars in
it's
my WhatsApp
Starlight
wallet,
or Stargate or something like that.
it's something like that, wasn't it? Is it a real bank? I don't even know. Um,
It's
but
It's a rent a bank.
it's an entity with a banking license. That's all that matters.
look, but the point is, look, Daniel, if I send money from my WhatsApp wallet, if I send one of these dollars from my WhatsApp wallet to your Instagram wallet, and then you send it onto Akuna's Facebook wallet, it doesn't go near the banking system. Swift don't even smell the transaction. It's nothing to do with them. So I stand by what I said about that. Now, if you're talking about moving wholesale CBDCs in the same way as swap lines, in other words, would the Bank of Japan be able to hold US dollar wholesale CBDCs for transacting between Japanese institutions? I'm not sure. I don't know enough about the topic to know yes or no to that. There's no obvious reason why not, but I don't know enough about it.
Yeah, thanks, Dave. And I think that is interesting that today, when bringing up that Japan buying commodities with other Japanese banks in U.S. dollars,
Mm.
their access to the dollar system is limited, I think, by real operational challenges. And maybe I'll make a comment on that point again about Swift and retail payments. And I said it earlier, and I again love to hear your opinion, Dave. But that 10% of the value that exists in retail systems, roughly, maybe that's okay that it doesn't touch the banking system, and it's not the biggest deal to companies that are targeting um, companies that are providing value for wholesale systems. So yeah, that 10% doesn't get aggregated into the wholesale at some later settlement point. You're right. It's a peer-to-peer transaction. Instantly gets, there is no settlement. The IOU, the transaction itself, is the settlement. I don't know. I guess I just don't feel like it's that big of a deal. Maybe if I was sitting here with a Swift hat on, I'd say, yeah, so maybe we have to fight a little bit harder for that 10% of our business, but our 90% seems maybe safe and secure. I don't know.
Is that still the case if the banks decide to do peer-to-peer via stablecoins, via their own stablecoins?
Well, you're absolutely correct, but it wouldn't even need to be their own stable coins, because
Yeah.
if I'm Barclays, so I'm Dave Birch and I've got a wallet that's got some US dollar stable coins in. So let's say Barclays has got a wallet that's got some US dollar stable coins in. So Barclays now needs to pay, I don't know, some other bank or some other company on the other side of the world. So they can dress up some messages in ISO 20022 and they can send them off through Swift GPI, and then the message will get through, and then the MT101 goes, and then you get the response, and then later in the day you instruct a settlement transfer from your Nostro account to their Vostro account, and that goes through a correspondent bank, and blah 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 blah. Or you can email the coins from your wallet to somebody else's wallet. So I don't think you have to wonder what Swift is going to do in a world of digital currency, irrespective of whether those digital currencies are central bank digital currency or Facebook's or anybody else's, right? Because the money just goes from wallet to wallet. There is no system in the middle for Swift to manage and organize and message, right?
So maybe I'll be a little bit controversial. I'm just interested. Having James on the line. I also see Harold Boss in the audience as well from Mastercard. So I'm just interested. When you think about Swift as a network, as a payment network, can you extend the same logic to the Mastercards and the Visas of the world, or is there something kind of fundamentally different there?
Ooh, good question.
Well,
Throwing debate in.
that is a controversial
Oh,
question.
it's interesting, right? Because Swift is a messaging network that supports a broken system that's called correspondent banking, right? It doesn't exchange any value. It works in a limited way, and yes, it's been enhanced from what I can tell with GPI and other things like that try and make it a bit faster and a bit better. It's still, for me, the kind of the polyfiller that's trying to fill in the cracks in what is a broken system. I don't feel the same way, and obviously I would say that about the Mastercards, Visas, etc. of this world, because I think they do a lot more than what Swift does, and I think they provide a lot more value to the people that participate in those networks than Swift does.
Yeah.
So I think they come from a totally different perspective on that. So I don't feel they are subject to the same threat. I will be the first to admit that they are a legacy of a time when you wanted to connect billions of consumers with millions of merchants through tens of thousands of banks. We had to use a technology which required, phone lines and people to connect up switchboards and things to join from, a switch in the center. And now that we have the internet and we have peer-to-peer technology, that technical reason for being doesn't exist. But in the 50 plus years that those networks have been built over, they have established significant brand presence. They have huge issuance and acceptance networks. They have holistic rules that provide trust and safety. And they do it in a relatively efficient way compared to some of the alternatives that we're looking at today in terms of how blockchain works and distributed nodes and proof of work, whatever else might be used, right? So when I first worked for MasterCard in 2014, I was kind of like, why does this thing exist? We've got the internet now, we've got, blockchain, blah, 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 blah. Now I'm looking at it 7 years on, I'm going, I have a huge amount of respect for having a unifying brand that means this will work wherever you are in the world. And if something goes wrong, you are protected. And I think that is phenomenally valuable. And I think that's why Wall Street values them associated in the same way. So I think they're very, very different things. I think if you were trying to put Swift and MasterCard and Visa in the same bracket, I think you'd be very wrong.
I agree, James. I mean, look, to pretend that it will have no impact on Visa and MasterCard is obviously wrong, because it'll, apart from anything else, it'll fix a price, won't it, at some point? But your point is correct. People think of Visa and MasterCard as payments, but actually payments is only one part of the proposition. And when I walk up to a store and I see a MasterCard sign in the window, that's not just telling me, you can pay here. It's got all this other